All right, everyone. In this video, I've got one growth stock that's down 83% that you could buy in bunches right now. I'm going to reveal what this growth stock is and why I'm recommending it so much, why I think it's an excellent buy, and potentially some risks with this growth stock as well, because every investment comes with some risk. You got to take some risk for the reward. So we'll discuss those as well. So without further ado, let's jump in. Let's see what this growth stock is.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the growth stock that I'm talking about here is StoneCo. StoneCo is down 82.56% off the highs it reached in 2021. Of course, one of the big risks right now with StoneCo is that Warren Buffett just sold off his stake. And so investors are curious, why did Warren Buffett sell? Does he know something that we don't? Is there a reason for that? And I tend to view changes and moves from big name investors like Warren Buffett with a grain of salt. These investors, they often buy and sell stocks for many, many reasons. And it's not always because they think a stock is overvalued or undervalued. They could have other reasons for investing or divesting away from a stock. One of those reasons could be diversification. They could be adding a stock because of the diversification benefits it adds to the portfolio, and they could think that the stock is only fairly valued and not feel that it's undervalued, and they're still buying it. So it's not always a decision of undervalued versus overvalued when they're buying and selling. So I always caution investors not to pay too much attention to what these big name investors like Warren Buffett, Cathiewood, these investors get a lot of notoriety for their purchases and sales. So one of the reasons I like StoneCo stock is the growth it's demonstrating. 2.142 billion in revenue in the trailing 12 months. That's up from less than 600 million in revenue in 2019. Another move I've liked from StoneCo in recent quarters is the company's decision to focus on more profitable customers. Previously, it had a growth at all costs type of strategy where it was going after all customers. It's more focused now, showing us that it wants to go after the higher value customers, and it's not so concerned if that comes at the expense of the lower value customers that StoneCo had been going after before. So I tend to favor companies that take this strategy because it goes after the higher value customers. I don't like just going after any customer, right? You want to go after customers that you can serve effectively and efficiently. Some customers are not meant for your business. They're not meant for you as a business. They're going to be too expensive to serve, and you're unlikely to keep them for the longer term. So why waste your effort and energy initially to go after that customer if it's going to come at the expense of being able to better serve your core customers? So I've tended to favor this business strategy over the longer term, and I like that StoneCo is going after this strategy right now. Also, along with its revenue growth, the company has generated nice profitability. You can see its operating profit margin in the trailing 12 months at 47.16%, recovering from that slowdown in late 2021, early 2022, and now bouncing back upward. One thing I haven't mentioned is I like the growth prospects of the Latin American economy. That's where StoneCo primarily operates. Brazil is the core country StoneCo operates. I like the growth prospects of those economies in that region. I think they're going to grow faster than the economy of the world overall. And so I like taking a company in an economy that's growing, not unlike investing in a company in an industry that's growing faster than an economy overall. So these are some of the reasons, macroeconomic reasons, I'm in favor of a StoneCo stock. Additionally, the company is cash flow from operations positive, significantly so, 493 million in the trailing 12-month period, and since I would say mid 2021, it's been positive in this regard, meaning that it's self-funding, self-sustaining, profitable, so it doesn't need to go to investors to raise more capital. It can fund itself. It can fund its own operations. And that's always a bit of a better investment when the company can fund itself. It's less volatile, less risky because it doesn't need to go to investors and potentially raise capital in an expensive way, right? Whenever you go to investors, you're always risking having to pay higher interest rates or higher costs of capital because you never know the state of the economy, the state of investor psychology when you go to raise capital. That's why when you're self-funding, when you've achieved profitability, achieved positive cash flow from operations, you don't need to worry about that. Of course, you can still go back to investors and raise capital opportunistically if you could get really good rates, but then you're not at the whim of those investors who would like to charge you more. You can opportunistically say yes or no if you want to raise capital or not. So for the next year in 2024, StoneCo is expected to increase its sales by 10.9%, double-digit sales growth, solid growth to be sure, especially because StoneCo's stock is not selling at a very expensive valuation. Let's take a look at that. The metric I chose to use is the forward price to earnings ratio, and here's why that's important. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. So now that you understand that, you can see at a forward PE of 11.04, that's not very expensive for StoneCo, especially considering the strong profitability, the strong cash flow from operations, and double-digit growth expected in 2024. So for all those reasons, I think StoneCo is one growth stock that's down big that investors can buy in bunches right now. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.